Welcome to Ask the Compound. I'm your host, Ben Carlson. On today's show, is buying the dip a legitimate strategy in the stock market? A lot of people are asking. We investigate. Stay tuned. Welcome to Ask the Compound, the show where we get better questions than a Jerome Powell press conference. How's that? Today's show, is it time to sell NVDA? People are a little spooked about Monday's little AI scare. Is keeping cash on hand to buy the dip a feasible strategy? I investigate how strong is the U.S. economy right now. We got lots of charts today to go over that. Could AI be a catalyst for small and mid-cap outperformance? Tons of AI questions today. What's the right time to sell those Apple shares with huge gains? Right? It's sign of the times. All the questions we get these days. Hey, I have tons of gains. What should I do? Tough,
Love to see it.
Email us, askthecompoundshow@gmail.com if you have a question. We are here every Wednesday at 1 p.m. Eastern Standard Time if you want to get in the live chat. I see a lot of people in there today, chopping it up. They all talk to each other. They don't even pay attention to the show. They talk to each other. If you have a question in the live chat, let us know. We'll hit you up. Fire away. Today's show is presented by Rocket Money. My first job out of college, I created a budget by hand, pencil and paper. Every week I'd go through and I'd update it. Here's my spending. Here's my bills, all this stuff. I don't have time for that anymore. No one does. Budget is like a four-letter word for a lot of people. People hate budgeting, but you need some sort of spending plan. That's where Rocket Money comes in. Rocket Money is a personal finance app. Helps find and cancel your unwanted subscriptions, monitors your spending, and helps you lower your bills so you can grow your savings. You can see all of your past spending, your upcoming bills, your payments and subscriptions. Rocket Money can even help cancel those subscriptions so you don't need them when you don't need them anymore. You can create a personalized budget with your own custom categories that track spending in different areas. Duncan probably has a category for hats. I've got one for sweaters. Plus, you get alerts on your bills if there's an increase or an unusual spending activity. Rocket Money has over 5 million users and has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Cancel those unwanted subscriptions today and reach your financial goals faster with Rocket Money. Go to rocketmoney.com/ATC. That's rocketmoney.com/ATC to learn more. Let's do it.
About once a month, I get a message on social media from a listener that says, "Hey, I think you accidentally posted Animal Spirits at 2 times speed." And I'm like, "Nah, Ben just talks that fast."
I'm a fast talker.
You're a very
fair.
fast talker. It's funny because you're Midwest. You're supposed to be chill, but you're a fast talker.
I got stuff to do. Let's go.
Yep.
I want to get it out of the way quick.
Yep. And on that note, up first today, we have a question.
You can't listen to Animal Spirits at 2 times speed or this podcast. I'm too fast.
It doesn't work.
1.5.
Okay. First up, we have a question that came in via Twitter. So is this it? Is NVIDIA finally cooked? Should I sell?
I think this was a response to a meme I posted. John put it up here. It's not bad, right?
Boy.
As a middle-aged guy, am I too over the hill to make memes? What's the chat say? Is this just the way that people talk these days? I'm young at heart. I'm still cool. I'm hip.
Hey, if you know how to make a meme, then I say, have at it.
Yeah.
If you're having to outsource your memes, then maybe you're too old.
Yes. As an older millennial, maybe I'm still barely in. So, NVIDIA was down nearly 20% at one point on Monday. I think it finished the day down 17%. Nice bounce back yesterday. Today it's down again, I think. It was essentially a 1987 crash for NVIDIA, which happens way more to individual stocks in the market, obviously. I don't have a lot of sympathy for you if you've been holding NVIDIA for a long time, just because of the gains you've had. John, throw up the chart here. This is just one of the most ridiculous charts of all time. I read a study the other day that showed the biggest gainers of all time. And I think over a 20-year period, NVIDIA had the biggest gain of all. And you can see how much of the gains have come just in the last few years. This is just a ridiculous chart. To be fair, John, throw up the next chart. The drawdowns in NVIDIA have been pretty drastic. I mean, a handful of 70 or 80% drawdowns. 2 years ago, you had 2/3 of your money was lost. So it's not like NVIDIA investors haven't lived through a lot. So congrats to all of those people who have. So we get questions from these people all the time. What should I do? I'm sitting on huge gains, and I don't know the right time to sell stocks like this because no one does. And I could opine on the AI race and how NVIDIA might be more vulnerable right now. Maybe they are, maybe they aren't. We'll see. I think the past week has shown us that no one really knows what's going to happen in the AI race. The tech people don't know. The stock market doesn't know. They did a profile on the guy who created DeepSeek in China, and they asked him what do you think? And he said he was surprised at the fact that his company took off and spread like wildfire like this. So even the people building this stuff don't know what's going to happen. So
Well, and also, so much of this is being based on the word of one company, one person, right? How much money they spent to build. They could just be making that up, right? They said $6 million or whatever. It could be 600 million, but they're just saying six to
yes,
cause
I do think there's a lot of people who are now questioning, like, is this really true? Did you really only spend that much money? And yeah, so I think people are kind of, it is funny. We went from a week ago, people thought the U.S. tech industry is indestructible. No one can touch it. And then on Monday, everyone goes, look at how far behind we are. China's way ahead of us. And then the next day, people go, wait a minute. Maybe they embellished a little bit, or they're, I don't know. China does seem to just pull their GDP numbers out of thin air every quarter. Like, we were up 5% again. Awesome. I don't know. So I think, listen, the returns have been magnificent in these stocks, pun intended. If you are sitting on huge gains, maybe the extreme moves like we saw on Monday aren't very fun for you anymore. Like, yeah, I sat through a drawdown in the past, but now I've made a ton of money. I don't want to take part in this anymore. So maybe all this AI investment keeps chugging along and it works out perfectly for them and it's all fine. Or maybe the ROI takes a lot longer than expected, or these companies don't invest as much as NVIDIA expects, right? I think a lot of it is, like, if you're sitting on these massive gains, how comfortable are you with a double-digit drawdown in a single day? Like, can you stomach that? I think that's the question you need to ask yourself. Is that, it's more about not trying to predict the future of AI and what that's going to be in the capital spending binge by these companies. It's like, have you made enough money where it's time for you to take some off the table so you can rest a little easier? Those losses hurt much more when the dollar signs are much bigger, right?
Right.
So that's the thing. How comfortable are you with the ratio of your gains to potential losses? And I think it was a wake-up call for a lot of people on Monday.
Yeah.
Oh, that's right. I can get killed in this.
And a lot of people are being reminded of the dangers of levered ETFs and levered single stock, ETFs.
You weren't in 3 times NVIDIA on Monday, were you?
I was not. No.
Okay. You have been in the past, though, probably.
I think so. But yeah, mainly just the triple Qs.
I think it was down 50% on Monday. So
yeah.
If you sat through NVIDIA, even with this 70% crash on Monday, you're probably still sitting on pretty hefty gains. So good on you. But you just have to have a plan of attack here, because the volatility is not going to go away. All right, another question.
Okay, up next we have...
Someone says in the chat that you can buy 5 times NVIDIA in Europe.
Oh, nice.
That's like the Gillette razors, right?
Is this a good entry? Is a good entry for a 5-time levered NVIDIA?
Is it possible for a fund to go down more than 100%? I don't know.
Yeah, where you owe more money to the fund company. Okay, so up next we have a question from John. I'm roughly 100% equities with a mix of S&P and global stock indices. I've ridden out the global financial crisis, COVID, and other downturns, and trust myself not to sell in a downturn. I've had good returns, but I was wondering if holding some bonds as dry powder to invest in downturns would be a better strategy. Would one of these strategies be better? First, hold 10% in bonds, and when stocks go down 20%, convert the bonds to stocks. Hold 10% in bonds and convert to stocks when they're down 10%. Hold 20% in bonds and convert to stocks when they're down 20%. Hold 20% in bonds and convert to stocks when they're down 10%. Historically speaking, would an investor be better off in one of these situations than sitting in 100% equities all the time?
Seth in the chat says Duncan's moving to Europe right away. Pack your bags. All right. In theory, this strategy makes sense, right? I'm going to sit cash on the sidelines, dry powder, buy the dip when there's blood in the streets, and be fearful when others are fearful, or greedy when others are fearful, whatever it is, all the sayings. My only concern is the implementation of this strategy, right? So, John, let's do a chart on. Let's look at the historical drawdown numbers. I did this for the S&P since 1950. And I look at how often are we in these specific drawdowns. And so it's roughly 1/3 of the time or so you are down 10% or worse. It's funny, only a little less than 8% of the time you're at all-time highs. So 92% and change over the last 75 years, you've been in the state of a drawdown, looking up at a previous high. It's only like 1 in 6 years that you're down 20% or worse. So, I don't know. My findings also show, you can do chart off, John, 2/3 of all years experience a 10% correction at some point during the year. That's peak to trough. So it doesn't mean you're buying at the very low. And hitting the 20% threshold, again, doesn't happen quite as often. So I looked at the last 10 years. 6 of the last 10 years, we've had a double-digit correction at some point in a given year. And 2 of those were 20% or worse, obviously 2020 and 2022. So, okay, let's say you move 20% of your portfolio into bonds, and then you say, every time the market falls 10%, because that happens more often, I'm going to buy stocks. Here's my problem with this strategy. Let's say you stick with a plan, and when stocks fall 10% eventually they move back up. Let's say they fall 10, you buy. They go down 15% in a correction, then they go back up. Your plan worked. Now what? When do you go back to bonds, right? Market timing requires you to be right twice, when you buy and when you sell. So, okay, fine. When the stock market rises 30%, then I'll sell some stocks again, rebalance the bonds. That's not a terrible strategy, but what if it keeps going up without another correction? So the stock market fell 34% during the 2020 COVID bear market, which was one of the fastest in history, and it rose well over 100% before we had another 10% correction. Huge move off the bottom. So what happens if you buy at 10% and the stock market keeps falling to almost 40%? And then you wait and it goes back up over 100%, and then you miss your 30% threshold, you sold stocks, and now you're sitting. And so I think that's a scenario that worries me, is that when the stock market doesn't cooperate. You have these rules in place, and it sounds great in theory.
Also, I mean, are you going to be sitting there watching your portfolio all day, every day? Because, I mean, some of this happens fast sometimes.
Yeah, that's the problem, is it requires more brain damage and more thinking, and that's my problem with it. I like the idea of placing rules around a strategy like this, but it requires an iron will to follow through with it too. And to your point, so I prefer picking a 90-10, 80-20, 70-30, whatever it is, and occasionally rebalancing and stick with that come hell or high water. That's way easier. Fixed income still acts as your dry powder. You might not time the rebalancing as well as you do with a correction. Like maybe you could say, I'm just going to rebalance when the stock market falls 10 or 15 or 20%. Like maybe that's more of your trigger there. But I just like the idea of having far less brain damage and more simplicity along the way. Someone in the chat asked if I'm a Michigan or Michigan State fan. Come on, look at all the Michigan gear behind me. Helmet. I got like the wine bottle commemorating the national championship last year. My daughter made me a coffee mug with an M on it.
Maybe it was a joke.
It's possible. Maybe, but I'm thinking this is the usual suspects. All the evidence is right behind me. Pick it up. So this theory again sounds great in theory, but not so much in practice. Buy the dip. I think you're probably better off just picking an allocation and sticking with it, and not trying to get too cute with this. Also,
this Barb makes a good point in the chat, saying that they used to do this. Being hyper-focused on the market is awful for mental health.
It is. Yeah. It's true. Yes. The more you pay attention, the harder it is to follow through with it too, because it's like, well, geez, last time I bought when the stock market was down 10% and it fell 25%. So this time I'm going to wait a little longer. And then the problem with this is that you keep probably moving the goalposts and changing your rules.
Yeah, you don't want to be falling asleep at night checking futures, see what the market's doing.
We know that emotions are the enemy of investors. And the more often you let emotions dictate your process, the harder it's going to be to follow it.
Yeah.
That's why simplicity works. Next question.
All right. Up next, we have one that came in from Blue Sky, which I'm still not on, but maybe at some point. What are your top 3 to 5 charts that show the strength of the current U.S. economy? I like this. Is like homework. Question. I like it.
First question we've ever received from Blue Sky. I'm now an occasional poster. So they asked for 3 to 5 charts in the U.S. economy, but we're offering a 2-for-1 special today, so let's bring in a reinforcement. Callie Cox, our chief investment strategist at Ritholtz Wealth Management.
Hey,
Callie, I knew I could count on you for this.
Hey, yeah. Well, I tell everybody my love language is charts, so I'm honored that you tapped me for this. I brought
we usually get questions about recessions and why are things going bad. So I like the fact that this was a positive question, right? This is show us how good things are. So
also, before we dive in, can you show off your shirt to people watching live right now?
Guys, happy Fed Day. Nothing but respect for my Fed chair.
Nice.
All right. Callie, you have one question for Jerome Powell. What do you ask him today? I'm putting you on the spot.
Ooh, why are you focused so much on inflation right now? Which I think is a very loaded question, but it's along the lines of, you say you're so data dependent. Well, the data looks fine, so why focus on inflation?
It's true. It does look pretty good. All right. What do you got for me? Give me some good news.
All right, so I have some charts, and I want to preface all of this with, if we're talking about the state of the economy and the health of the economy, I always think about spending first, consumer spending specifically, because consumer spending is 70% of the U.S. economy, 70% of GDP. So I have a few charts on the job market, and then I have a few extras, Ben, and I'm excited to see what you brought, because I know you agree with me.
I brought charts too.
Yeah. So chart on, John, first one. All right, so If I had to describe the job market right now, I'd say it's okay. And remember, I'm looking at this through data-driven insights. The feel of the job market is probably a lot worse or a lot better depending on where you work and what sector you work in. But so far, if I had to point to one chart that makes me a little bit worried about the economy, blue sky, it's this one. The unemployment rate has been climbing for about a year or so, and it's been climbing for good and bad reasons. Next chart. Yeah, it's been climbing for good and bad reasons. When we think about unemployment, we typically think about mass layoffs, people losing their jobs. But there is good unemployment too. People entering the workforce, they're initially unemployed. The hope is that they enter the workforce and get a job soon. But in the interim, they're counted as unemployed. And what you're seeing here is initial jobless claims as a percent of the workforce. If you see this climbing quickly, then you better get worried. It shows that there are mass layoffs happening, but that's simply not the case. One other chart that, makes me a little suspicious of the job market right now is this one. People are having a harder time finding a job. And look, Ben, I know that we both look at the economy from a bird's eye perspective, but if you dig into sectors, there are a lot of different sectors that are driving hiring right now. Or excuse me, there are only a few sectors driving hiring. And
So where's it
there are a
coming
lot
from?
of sectors. What?
So who's actually hiring these days? Because I know the housing market has to be in a lot of pain. That sort of stuff has to be slow. So who is actually hiring?
Well, that's exactly it. The top three sectors right now are the government, which LOL at the headlines over the past few days, education, and healthcare.
And DeepSeek AI.
Yeah.
I mean, tech hiring has been okay. It's been okay. We're in a bit of a white collar recession, but if you look back at this chart, people who are unemployed have been unemployed for an average of 23 weeks, and we've seen that spike, showing that people are having a harder time finding a job. So going back to consumer spending being such a big part of the economy, this concerns me, right? Because, if people start losing their jobs, they're more likely to pull back on their spending, and consumer spending is such a big part of the economy.
And the hard part to gauge on this too is how much of this is a normalization because we had such a hot job market before, and how much of this is a slowdown. And that middle ground is where it's tough to actually figure out what's going on.
Exactly. And I like to look at the quits rate for that, Ben. The quits rate, the rate of people quitting their jobs voluntarily, is near where it was in 2018 or 2019. So I'd say that we're a bit weaker than normal, and what even is normal? I'm thinking about the 2010s here, but it definitely makes me nervous because job market trends are moving in the wrong direction. I'll throw out two more charts and then I'll hand it over to you, Ben, because I want to see what you brought.
All right, what do we got?
But two more quickies. So corporate profits, how much money corporate America is making. Sometimes we can be skeptical of corporate America, but look, they employ us. We're all more intertwined than we could ever have thought possible. So profits matter. The market moves on the economy and earnings. And corporate profits are rebounding, at least for large cap stocks. If you see on this chart, the 2025 figure you see is actually what Wall Street analysts expect for S&P 500 profits this year. They're expecting double-digit earnings growth and earnings growth in every single S&P sector. Pretty much the perfect year for corporate America. And this can be a good or a bad thing, right? The bar is really high, but I think if you're worried about the state of the economy, you can take comfort in this.
So there's no sandbagging going on right now. Everyone is kind of pushing their chips in all in the boat kind of deal.
Oh, there is sandbagging going on. There's always sandbagging.
As
but
always. Okay.
Yeah, there's a little less sandbagging than we usually see. But I would just take it back to the components of the economy. And John, if you want to throw my last chart up. Whenever you think about the economy, you have to think about the components of it, the components of GDP. You have your consumer spending, you have businesses spending, spending on the housing market and spending on houses. And then you have these, added components, change in inventories, which is a little noisy, net exports, which is essentially the health of trade, and then government spending. And all I want to point out, Ben, is that, if you think of these as legs on a stool, then we're sitting on about half the legs right now because the housing market is frozen. There's some trade policy up in the air. We have no idea what's going to happen there. And, if you believe the administration in power right now, then we could see lower government spending. That makes me feel nervous, but right now we're okay.
So consumers are basically like the unicycle right now. We're driving.
We're the unicycle. That's a great analogy.
Yeah.
Also makes me more nervous because unicycles.
Yeah, no thanks. John, let's go through mine real quick. I think this is one of the craziest charts of the decade. You mentioned 70% of the consumer is 70% of the economy. Retail sales, obviously some of this is inflation, but it's still kind of heading in the right direction. Next one, John. JP Morgan does a really good chart in their guide to the markets showing the consumer balance sheet, and you can see assets are dwarfing liabilities. The household debt service ratio is not bad. Not a ton of delinquencies on auto loans, mortgages, credit cards, or student loans. So even though the consumer is the total stool right now, they're doing pretty well. John, next one. This is one of my favorite charts, $35 trillion in home equity. This was less than $20 trillion heading into the pandemic at the beginning of the decade. So just a massive, almost doubling of home equity heading into the crisis. What else have I got? Oh, from the New York Fed, John, next one. This is foreclosures and bankruptcies. This is historically low, almost about as low as it's been. Obviously, the foreclosure thing makes sense that it's pretty low because everyone has those low mortgage rates or paid off homes. And then one more, Callie, you mentioned you'd ask Powell about inflation. This is G7 inflation rates across the globe. And you can see they've all relatively normalized and taken a lot of volatility out of there, which I think is a good sign. Doesn't mean it can't snap back, but at least for the past 18 months or so, inflation is relatively calm. So my thought is everyone thought we were going into recession in 2022, 2023, and 2024. No one thinks we're going into recession in 2025. Maybe that should be cause for concern, but it seems like the economy is at a pretty darn good place right now, all things considered.
But that's what matters for your portfolio. Expectations matter. So keep that in mind as we head into a year when everybody is so excited about what's going on.
Right. Yeah, the hurdle keeps getting pushed higher and higher, right? Mm-hmm. And jumping over it is a little tougher. And yes, if those high expectations aren't met, even if the economy doesn't go into recession, we could still see a sell-off in the market.
Correct. Yeah. So that's my biggest worry.
This somehow feels scarier than back when everyone was saying that everything was going to come crashing down. To me, it does. Just as like a retail person.
If you're a contrarian person, then yes. But sometimes fighting the trend is just as bad, though, right? Because most of the time you want to go with the current.
Oh, don't worry. I mean, I'm still buying penny stocks and all kinds of crazy things. So not selling or shorting, but yeah, just feels.
I love in the chat.
Duncan's hedge is going from 3 times to 2 times.
Yeah, somebody in the chat suggested a 5 times Oatly ETF. Duncan, maybe you should look into that.
I mean, I'd be down.
He would fund it. He would fund it from day one. All right.
He would issue
another question.
Okay, up next we have a short but sweet question. Could cheaper AI development be a catalyst for small caps?
Okay, I think this one came in on Monday, and people saw like, oh, wait a minute. It was like this glorious day for diversification. For one day, tech stocks sold off, growth got hammered, value stocks and small caps and mid caps and international stocks and all these other areas of the market that have been lagging actually did well for one glorious day. So let's say that there's not a need for all this capital spend, or the Mag 7s companies spend way more than they needed to, and they don't get the ROI on this. Does diversification finally work? What are you thinking on small mid caps these days?
Well, I want to separate these two, Ben, because I think that this is, obviously AI is like a freight train of a story, but it's a long-term story. Like there's a lot of speculation right now, and at best, we're seeing a lot of spending in early development. So, if you ask me what the biggest story is for small caps right now, I'd say the rate environment and the economy, because small caps are extra sensitive to the US economy. They're smaller, they don't have the scale to go internationally, and they are more debt sensitive because many of them aren't profitable. Many of them have to reach out and get external capital, and interest rates are high right now.
Right, which makes sense for why they sold off in the last couple of months, because rates went higher.
Right, exactly. That's the whole story of why they've done so poorly since the October 22 low. Usually coming out, and if you want to throw the chart up, this actually explains it well. Next chart. Yes. Usually small caps do really well in the beginning of cycles because the Fed tends to cut rates at the beginning of cycles, and growth tends to bottom out. It gets better and better as the economic cycle turns. We got that economic cycle turning, right? The economy was weaker. You can make an argument that the economy was weaker over the past 2 years, but we haven't seen those interest rates come down materially. So small caps just keep getting trounced by the fact that the rate environment is so high and people are so worried about where rates will go. I almost describe it as the Fed, keeping its foot on the neck of small caps, because that's what
John-
that's what's happening. It's
John,
investor
throw that chart
restraint.
back up. So to your point about pivots in the economy, you can see in 2020, small caps came out of the gates after the pandemic and we're off to the races, right? And I do think this is an important chart because it shows that these things are cyclical. I know some people want to believe that cycles are a thing of the past. Maybe they are. I don't know. I tend to believe that cycles are still around, and this chart does a good job showing that these things take turns and they go back and forth. Nothing lasts forever.
Yeah, and I don't want to dodge the question. I mean, if you think through it, AI is a long-term story, then I would say a few things. I mean, cheaper AI is coming. That's what happens with every technological innovation. We get the innovation, we get more efficient at it, we get more competitors, prices come down. Small caps are more cost sensitive. They don't have as wide of profit margins. Some of them are unprofitable, many of them are. So there's a bit more of a need for cost control there. And you have to remember the dynamic of, AI boosting productivity and making things cheaper, which is a thing. It's more output for the same or less cost. So yeah, could this be a story for small caps? Maybe. I just wouldn't expect it to materialize over the next year or two.
And it doesn't have to be one or the other. It doesn't have to be AI is going to
Right.
be just good for large caps and bad for small caps. They could both do well, and maybe smaller businesses actually are the ones who benefit from this. John, throw the valuations one up. So this is valuations for the S&P, small caps, mid caps, and then international stocks. And you can see all these other areas of the market are much lower priced. And getting back to your point about expectations, the expectations are much lower there because the valuations are lower. And the expectations are higher in large caps because the valuations are higher. And so the expectations are higher, sorry. And so I think it's just the margin of safety thing, that there's just a bigger margin of safety in these other areas because they've been beaten down and haven't kept up. And that's, if the expectations get too far ahead of themselves, that's the risk for large caps, is the way I see it.
Yeah,
So
it's
this
funny
might
how
be
things boil down to expectations, always.
Yeah.
This might be a dumb question, but is there a reason we're saying small and not below a certain market cap? Do micro caps trade meaningfully different than small caps?
You wanting us to do a penny stock index for you, Duncan?
Well, no, I'm just curious. I'm just curious why small caps specifically, and not just all companies under this market cap.
Well, the market cap thing changes as it's kind of a moving goalpost. So it's typically the Russell 3000, the 500 biggest stocks are the S&P, and the Russell 2500 is the rest of them, basically. And that's small and mid. It's kind of how they break it down. But it's kind of the numbers of the market caps actually kind of change over time.
Okay.
Yeah.
But so
and I think
micro
the
caps
general
are their
rule
own
of thumb
thing.
is, general rule of thumb for small caps is 2 billion and under, and I think for micro caps it's 500 million. But don't quote me on that.
Okay. I pulled up a company that had a $5 million market cap the other day, so it's micro.
Ken,
I didn't buy it. I was just looking.
Are you trading on the pink sheets here? What are you?
no.
Okay.
All right, we got one more.
Last but not least, this one's anonymous, which it's a good one. After college, I used some of my very limited savings to buy Apple shares. This was back in 08, 09, around the time of the crash. Obviously, they've gone up massively over the years since. I sold a little when my wife and I were younger and we needed cash for some major expenses, but for the most part, I've held on to the stock as it went up. Now I feel a little stuck. Apple makes up about 25% of my net worth, which I know isn't great from a concentration perspective, especially when my index funds also hold Apple. Yet, I kind of hate the idea of paying the 15% tax on my gains if I sell some. I'm not sure what a better investment would be, and also, if I'm honest, I have a little bit of an emotional connection to the shares since they've done so phenomenally well for me. How would you think through what to do next?
I like the way that they phrased this question.
This is a nice not to brag. I like this.
When Steve Jobs died, and I think it was 2010, 2011, Apple's shares actually had a pretty good sell-off. People were really worried about what was going to happen. And I bought some shares back then, and I think I sold them for a nice gain by 2016 and totally missed the second run-up. So I didn't get quite as emotionally connected. That last part of the question makes me think of the quote from Adam Smith, who says the stock doesn't know that you own it, right? And getting that emotional connection. I understand why it happens, but I think you have to be careful with that. And this is actually good timing because, Callie, you just wrote a piece on Apple and holding for the long term.
I did.
And how,
I actually thought Ben planted this question for me. I was like, oh my gosh, you're so kind. But no. On January 21st, I wrote a piece on how investing in growth stocks, golden ticket stocks, is mental torture. And look, whoever wrote in, first of all, I would put your name there. I would brag about it. But also, good for you. You've held Apple for 17 years, and look how much, I mean, Apple as a company has developed. So it's a lot harder than it looks, right? We always talk about, what if I buy this IPO and then it goes to the sky like Apple? But in reality, there are so few investors who are able to hold stocks like this for so long because
Yeah.
they do really well and because their sell-offs are especially extreme.
There's been plenty of drawdowns along the way over this time period, even though Apple shares have done amazing.
Yeah, 6 bear markets since 2008, 2009, which is when the reader bought the stock. 6 bear
Right.
markets. It's not easy.
So, like, what do you do as, like, just to, like, just take the Band-Aid off just a little bit, just to, like, get this thing started? Do you set a threshold for a percentage, right? Like, okay, it's 25% of my portfolio now, but I'm going to take it down to 15 or 10, or I'm going to sell a little bit every month, or what's the easy way to ease into this thing when people are so emotionally attached? Because the spreadsheet answer is you sell it all and just take the tax and eat it, and great, you had the gains. People's brains don't typically work like that, right? So what's the simple way to get out of this in a less impactful way?
Well, I would take a step back here because I think that there's a behavioral element that you have to check on first. Obviously, you bought Apple shares for a reason, right? You were bullish about the company. You wanted to invest some idle cash. You have a why or a story behind it. I think first you have to remind yourself of the why. Why did you buy this in the first place? And the follow-up question there is, why are you holding it? Because I think your why dictates what you do next, is my point. But you brought up a good point, Ben. You don't have to, sell it all, right? You can sell it in increments. You can, sell a little bit here on an Apple earnings day. You can sell a little bit here if, Apple falls 10%, which it just did, by the way. I think numbers are important here. I like setting targets for the stocks that I own because I love numbers. I resonate with numbers a lot, but also it gives you this, quantitative kind of accountability where you can say like, okay, yeah, I set this back when I bought it that I would, sell Apple when it hits $200 a share or something, and boom, there you go. This was my intention, and that's my target. I don't know if the reader has that, but if we're talking about whys, I would definitely think about targets in that conversation too. But yeah, I would go back to what you said, Ben. You don't have to sell it all. You don't have to, the world's not black and white. You don't have to throw all your money into one stock. You don't have to sell all one stock if it becomes a big part of your portfolio. Just be measured, take steps, and, biggest of all, pat yourself on the back and buy yourself something nice. Like you won the game.
Yeah, that might be helpful too. Is like using the money for something, right? I'm gonna sell some Apple shares. Sure, I have to pay the taxes. And Bill Sweet would always tell you, do not let the tax tail wag the investment portfolio dog, right? If you're paying the tax, that means you won. That's much better than the alternative of picking a crappy stock and watching it crash, and then sure, you got the tax loss harvesting, but you didn't get to pay the tax. Like paying the tax means that you did okay, and you're paying long term as well. So I like the idea of the reverse dollar cost average, where you're selling it off in chunks as opposed to doing it all at once and ripping the Band-Aid off, and slowly but surely diversifying, and you're going to get out at different entry points. And I think that's okay too. I think you slowly set a path. Like you said, maybe there's some earnings days where they're up 10%. And you say, if they have a big pop, I'm going to sell some more, right? Otherwise, I'm going to stick my plan, and once every month, I'm going to sell 1/20th of my position, or whatever the number is. Pick a number and stick to it. And that's the biggest thing for most people, is just picking that number and sticking to it. And starting early in the year like this allows you to plan ahead for taxes too, right?
That's a great point. Yeah.
If I'm going to sell a little bit every month, I know what the taxes are, and I can start planning for it now and setting money aside, whether it's part of the gains or money elsewhere, or start taking losses elsewhere to try to offset some of those gains. So now you have plenty of time. It's still January to plan ahead for the tax impact, and doing it now, I think that makes a lot of sense.
They also talk about not knowing where to put the money if they sold. But I'm guessing both of you would not recommend trying to pick the next Apple, right? You would probably just say put it in the market, put it in a ETF or
Well, I think that's why you have an asset
Take a nice
allocation.
a vacation. Okay,
Well,
sure.
yeah, if you don't want to spend it, if you have an asset allocation in place, that's what makes this much easier. Is you don't have to think about it, right? I'm going to put it in the allocation that I have, and follow that. That's why you have a plan in the first place. Is setting those, to your point, Callie, the boundaries and the limits.
Yeah, I would go back to the targets, exactly what Ben said. And even a step before that, I would talk to myself about my why. if I'm looking to build this nest egg over decades, then I think that answers your question. I mean, think about, a passive fund or something.
But if they were to put it in a single stock, what would you recommend?
I mean, Oatly. No, I don't do recommendations. That was 100% a joke.
That's a joke.
Duncan's been on a heater lately with his trading account.
Advice.
He's the one who should be offering stock picks here.
I know.
Don't mention any names.
Yeah,
Duncan, you don't want to jinx it.
Yeah, let's not jinx it.
You don't want to jinx it. All right. Callie, remind everyone where they can sign up for a newsletter if they want to read more pieces like the Apple one.
Yeah, well, first of all, thanks for having me on. This is always so much fun, especially on Fed Day. If you want to sign up for my newsletter, it comes out every Monday morning, optimisticcallie.com. It is on Beehive. I don't know if you can search it through Beehive, but Wall Street quality insights for the everyday people like us every Monday morning.
Very good. If you have a question for us, askthecompoundshow@gmail.com. Leave us a review for the podcast. Leave a question or comment on YouTube. Thanks to everyone in our live audience on YouTube, on Twitter. We appreciate it. We'll see you here next time, same place, same time.
See you, everyone.
See ya.